Welcome to the Monday edition of On the Tape. I'm Dan Nathan. I'm here with Guy Christopher Adami. If you guys were wondering what the C was, it's Christopher. And of course, Liz Young. That would be EY from SoFi. Guy, welcome back, buddy.
It is a joy to be back. A lot of people think the C stands for cool cat, but no, they'd be incorrect. It is, in fact, Christopher Adami, GCA.
Have we delved into what EY's middle name is? Is that something? Has that been a topic of conversation?
Yes, we have, but maybe she will enlighten us.
My middle name is Francis, Elizabeth Francis.
That's a tough handle, Guy.
Sounds Catholic, but actually was not named after anything Catholic. And Francis for a female ends C-E-S. Don't make that mistake of spelling it C-I-S.
Take it easy,
nuts.
Francis.
Yeah.
There's a great place in Lower Manhattan, I think, for some of you denizens of Wall Street. You will recall, of course, Fraunces Tavern, the oldest establishment in New York City. George Washington feasted there back in the day. Back to you.
Well, Guy, when you started trading below the buttonwood tree, isn't that where you used to go and get a frosty beverage after a full day of tape trading? And literally it was tape trading.
We called them ciders then, but yes, you are correct.
All right, let's get into it. Listen, we're going to have our fun conversation. We're going to set you all up for the week ahead. And it is a big week here, guys. We got like major earnings coming. Microsoft, Google tomorrow night. We have Meta. And then we also have Amazon later in the week. This week, it's kind of interesting. Apple is a week later than normal. Usually it's clustered with all of those. So we're going to get big tech readings. We're going to hit on a couple things here. There was some calls for a lower dollar, what kind of bank earnings mean for the potential for a looming credit crunch and who is going to be affected first. So let's talk about all that. And obviously sentiment in the market. Guy, you just mentioned something I thought was interesting. You've been gone for a week and you said the market's basically the same exact spot it was when you left. So let's hit all that. Also, after this conversation, we have Alfonso Peccatiello. He is the author of the Macro Compass. He is on Twitter at MacroAlf. He is a great follow, great read, and we had a great conversation about what he is expecting for U.S. economy, global economy, and what he thinks different risk markets are pricing for that. All right, Guy, hit us on that reflection here, because I'm sure you were checking in on the market over the course of the last week. But sometimes it's really interesting to be away from your FactSet machine, not staring at every tick of the things that you're looking at, not following every headline, not speaking about it all day as you do on Market Call and on the tape and on Fast Money. What's your reflection here as we're getting in the meat of S&P earnings for Q1?
Yeah, well, look, I think Friday the 14th is when I left, and I think the S&P closed around 4137. And as I'm sitting here staring at my FactSet machine, the S&P is, wait for it, 4137. So that would imply not a lot of movement. Now, I'm sure we saw some ups and downs along the way, but each time that I sort of checked in, there didn't seem to be a whole hell of a lot going on. You had some moving bond yields. I guess gold gave a little bit back. The VIX has been trading either side of sort of between 16.5 and 18 or so. But as I'm sitting here, it doesn't look like all that much transpired during the week. With that said, I'm sure there were some interesting headlines that you all spoke about last week without question, and I'm sure there were some individual stock moves too. I think there was an NVIDIA upgrade while I was gone. But, in terms of the broader market, it doesn't seem like all that much has happened. And maybe it's just waiting for some of the data we have this week and some of those very high-level earnings that you mentioned. But clearly, in terms of the broader market, a bit of a snooze fest last week.
Yeah, Liz did some heavy lifting for you, Guy, while you were gone. We sure did. A couple market calls, a couple on the tapes here. Liz, thoughts here, because it seems like we digested those bank earnings. They weren't as bad as expected. We spent a lot of time on Butter's data talking about how estimates have come down for S&P earnings over the course of Q1. And this has been a trend that we've seen a lot throughout 2022 when the market was clearly in a bear market, where estimates would come down, companies would beat. Strategists were, I guess, a little bit more hopeful, right? Because the bottom wasn't falling out here. Thoughts on what you've seen so far and what you expect just from a sentiment standpoint as we get into the meat of some of the biggest companies in the S&P 500?
Yeah, I mean, this is a huge week for earnings. Also a huge week on the macro front. We've got GDP, PCE, both sentiment readings, home prices. It's just a complete influx of data. And I think the market's going to have a lot to look at and think about. But to your point, bank earnings did get digested pretty well. The big banks, though, came in reasonably positively, right? And I think I've said this before, the regional bank's loss was the big bank's gain. That being said, banks have been hit pretty hard. The sector as a whole, the industry group as a whole, trading below book value. And historically, where things are trading on a price to book basis has been a pretty good predictor of the next 2 years of returns. Now, I'm not saying that we should plow all our money into banks right now, because I still think that there's some uncertainty and some risk out there, but where they're trading is certainly more attractive than where it would have been had we not sort of digested all of the risks that are still out there. Some of the stuff that I still think is coming that will not only affect banks but affect the rest of the market is still this credit idea and this pullback in lending, this pullback in availability, not just for big companies but small companies. And I think we underestimate how much small businesses really have an influence on the entire economy, not just on an employment level. They employ something like 80% of all of our workers, but also just it's the American way. You start as a small business, you grow into a mid-sized business, and then into a large cap business. So if small businesses are unable to get some of that financing because bigger banks are pulling back and credit standards have tightened, that's sort of the canary in the coal mine that could come up later.
Yeah, so Peter Bookvar, our friend over there at Bleakley Advisors who writes the book report, check it out. It's one of my first reads every morning. He was highlighting this. It was a Wall Street Journal article over the weekend, Why the Banking Mess is Not Over. And they were quoting economists at Goldman estimate every 10% decline in bank profitability reduces lending by 2%. And I thought that was really interesting. And then he goes on to hit exactly what you're talking about, Liz. What is the impact on small businesses? Guy, businesses with fewer than 100 employees receive nearly 70% of their commercial and industrial loans from banks with less than $250 billion in assets, and 30% of such lending from banks with less than $10 billion. That is according to Goldman. And so when you think about that, right, and you think about this looming sort of credit crunch, if there is this decline in earnings from banks, that is something that you really want to track pretty closely, because if credit seizes up for the lifeblood of the American economy, we are going to have less employment, we're going to have less CapEx investment, all the like here.
Seems like an inevitability to me. If you connect the dots and see what's going on the field of play, it would suggest that that's exactly what's going to take place. And it makes sense. And I don't think, and we've talked about this, it's no longer about where interest rates go. I mean, I think that will move the broader market here and there. But in terms of bank lending, it comes down to more strident credit requirements and stricter credit reserves and credit levels in terms of lending. They're just not going to be as apt at lending as they were in maybe environments 6 or so weeks ago prior to Silicon Valley. It's probably longer than that now. So with that said, it's just going to be a tighter credit period. I think people that had access to credit will no longer have it. And if they do, it's going to be at much higher rates. I think that's going to be problematic. On top of that, you're going to start seeing more and more layoffs, I think. So it's this whole pastiche that you have to talk about. And what does that mean to the broader economy when 75% of the U.S. economy is driven by people buying stuff? So I don't know how you unravel that and come out to some sort of bullish narrative. It just doesn't make a lot of sense.
Yeah, and I guess if you're thinking about it through the lens of the public markets, keep an eye on the Russell 2000 small caps. And we've noted the underperformance year to date. It's up a little less than 2% versus a NASDAQ that's up 16%, and S&P that's up nearly 8% on the year. Liz, I want to hit this, and I think our listeners know very well that you are not the sort of strategist that puts out price targets for the major indices. You don't have estimates for earnings for, let's say, the S&P 500. And, we've noted this a lot over the last, I would say, couple months. It's really hard to find a bullish strategist at a large investment institution. There are not many of them out there. And sometimes it's easy to get caught up in what your clients are saying and what your, kind of what the headlines are, what the narratives. And I thought this is interesting. This is Savita Subramanian from Bank of America. She's somebody who comes on CNBC a whole heck of a lot. I think she was one of the first strategists in early 2022 to really kind of turn negative and call for this earnings recession, and then become a bit more negative on the economy. And this was a quote, I think, in her note from this morning. She is pondering whether the 2023 EPS target of $200 for S&P 500 earnings was too grim, according to a note to clients this week. Consensus earnings for the S&P over the next 12 months are $219. We've seen some strategists who say worst case scenarios they could see $180. So what does it mean 4 months in that she had been negative and right for the better part of 2022? She was doubling down into 2023, but now 4 months in, where we went from hard landing, soft landing, no landing, back to soft landing after the banking sort of thing. If you're trying to kind of second guess or rethink your worst case scenario, what does that mean to you when you start seeing those sorts of moves by strategists? This is your peer group.
Yeah, well, first of all, as a strategist, number one, most of us, if not all of us, have to do writing from now and again and pretty often. And here's the difficult part. This is why you don't find a lot of bullish strategists at this particular moment, because when you sit down and really put your fingertips on a keyboard and try to break down what are the reasons why I can be constructive, you run out of reasons very, very quickly. And writing is a task that really puts a huge spotlight on that, right? You can sort of talk your way around things, but you can't necessarily write your way around things. So you're not going to find a ton of bullish strategists because there isn't a ton of data to support it. What I would say about Savita's comment, it sounds like maybe she's being a little more constructive on earnings, but not necessarily on the environment itself. It didn't sound like she extrapolated that out into the broader economy or into where the market was going to be headed. The way that she could be right, in the sense of maybe estimates are too low, although let's keep in mind that estimates being at this level is still flat year over year compared to 2022, which I still find difficult to imagine given the environment. However, where she could be right is that tech makes up such a big part of the index. If they cut enough costs, and I've said this quite a few times, if they cut enough costs, they cut enough heads, they cut enough of the fat to maintain their margins better than what maybe we were expecting, that might be the case. If tech comes in and surprises us, which we're going to start finding out this week, but I think second quarter earnings are probably the bigger one. If tech comes out and surprises us with wider margins than we thought they would have, then yeah, earnings might be better than we expected. I will say this, I made a bet with somebody that earnings would be negative year over year, and this person thinks that earnings are going to be positive more than 5% year over year. I won't call out who that is, but either way, somebody owes somebody a pizza if that's the case. And I do still think they'll be negative. It might just be negative 1%. But again, I can't imagine a scenario where earnings are flat year over year.
Get a sausage pizza with red onions, by the way, when you do emerge victorious, which you will.
No, you can't do it. Wait, hold on, guy. Hold on. You cannot do red onions, and I'll tell you why. If those red onions, all of the moisture will come out on that pie, and it just leaks, and it makes what should be a nice, firm crust really soggy there. And if you try to pick that piece up off of the pie with all those red onions on there, it's a total disaster. It's going to turn into soup in the middle. So as someone who's half Italian, half Sicilian guy, I thought you would have known better than that.
Yeah, no, listen, I love a red onion. I mean, or you could do what ex-Mayor de Blasio would do, and he would eat his pizza with a knife and fork, which is deeply troubling. Very Midwestern, by the way. Hopefully, I'm insulting half the country. Yeah, that's why
I don't fold my pizza. That's a sandwich.
No,
pizza,
it's a calzone.
No, it's folding your pizza is the acceptable.
No, there's no folding.
Anyway, what I was going to say. First of all, yes, I do think you will emerge victorious. Second, you can't cost your way to profitability. Yeah, it might work for a quarter or two. And I think we saw that. If you want proof positive, go back a couple quarters ago and look at the Disney report, where the stock, I think that day closed around 102, reported earnings. I think the stock was north of 121 in the aftermarket on this cost-cutting initiative. We talked about it on Fast Money that night and then subsequently on Market Call and on the tape. Said, look, that's great, but how sustainable is that? I mean, that's not a long-term business thesis that you can cut your way to greater margins and greater profitability. So yes, maybe for a quarter you'll see it. But, I've read over the weekend, a lot of people still think the lag effect from a Fed over the last 9 months still has not been felt. And I would agree with that.
So, Guy, let's talk about this NASDAQ 100, okay? So the ETF that tracks it is the QQQ here. And when you look at what is expected between now and Friday's close, the at-the-money straddle in the QQQ is about a little less than 2%. And if you look at the NASDAQ, the NDX chart, and you look since the start of this month, how tight of a range that is trading. Right now, the NASDAQ is trading at 13,000. It's traded as high as 13,200, okay? And as low as about 12,800. Okay, so it's traded in a 400-point range. We're at the dead midpoint about it. The implied move between now and the end of the week, and we're going to have Microsoft and Alphabet tomorrow after the close. We're going to have Meta, and we're going to have Amazon, and I think that's probably at least, 20 to 25% of the NASDAQ 100, and then Apple next week. And you say to yourself, something's got to give here, because the flatlining of an index like this, which really so many people, I think Liz just said it, and so many people that we know who maybe don't even drill down so much on the fundamentals of these companies, but they're really focused on the, I guess, how much of a weight they are of the major indices. Something's going to give, and it's going to give fairly soon. So, Guy, just curious when you see that sort of sideways price action on something that has generally been pretty volatile over the last, call it 12 to 16 months.
I looked at the S&P, as I said. I think there might have been 1 or 2 days last week where the S&P closed within a handle or two of being unchanged, which is interesting. And you brought up the QQQ, rightly so. A lot of people would say, okay, we've leveled off. We're building a base. The next leg is going to be higher. I would understand that. I mean, that's been the trajectory. A lot of other people would say this is a classic topping out formation. Then you have to ask yourself, I mean, under what set of circumstances does this index justify being here? And out of all the names you mentioned, for some reason, I keep coming back to Microsoft, because I do think that's a really interesting tell on not only the environment, but the market sentiment as well. The last quarter, if you recall, and I know you do, that stock traded as low as 222 off what was, by Microsoft standards, not a particularly robust quarter. And it got its second wind on the back of this whole AI thing that seemingly cropped out of nowhere, with names like NVIDIA going ballistic. And I think Microsoft sort of got caught up in that wave to the upside. But the entire move higher from that 220 level, I think up around 290 or so, was really just on the back of multiple expansion. How sustainable is that? Because I will tell you, things on the ground didn't get much better. So to answer your question, what it tells me is, in my opinion, we're at this topping formation where people are not going to be as apt or prone, or their want's not going to be to pay what I believe are pretty excessive multiples in an environment where they actually should be looking at much lower multiples. And, quickly back to Savita, talking about 200, 220, 222, whatever it takes for you Michael Keaton fans. It's still, what multiple do you want to put on that in this environment? An 18 multiple does not make a lot of sense to me. We have traded as low as an 11, I think, right around the great financial crisis and in the months after. And I'm not suggesting we go there, but to think we can't go to mid-teens, I think is just foolish.
All right, just so you know, it's 220, 221, whatever it takes. That's for all you Mr. Mom fans. Guy, you know that Michael Keaton is coming back as the Batman. He was the first Batman. And yes, he is. And he's going to be in like the latest kind of version, which is pretty dope for him. Liz, on the flip side of that, so Guy just talked about how Microsoft has seen this multiple expansion, and for a whole host of reasons, okay? You've seen this flight to sort of quality, and, definitely during the month of March, when we had this banking turmoil. We've also seen a lot of excitement about their partnership with OpenAI and what that could mean for them if they were to gain some share in search with Bing, but also as they integrate it into their productivity tools. The other thing I think is really interesting, and let's go back to Friday. Procter & Gamble reported, okay? So here's a stock that trades 27 times earnings, Guy, when we're talking about multiples. And you brought this up with Pepsi last quarter, okay? What percentage of their kind of gains were coming from pricing pressure versus organic growth? And that was something that was very evident in Procter. I think they had 7% pricing growth versus 3% product growth. Okay, so they still have this ability to kind of raise prices here. So my question, at 27 times for Procter, trading very near a 52-week high, what does that mean to you when you think about, so we're seeing some stuff on, that some people will say that some of these major mega cap names, because of their moats, because of their balance sheets, because of their managements, their monopolies, are basically like consumer staples. Are we going to see maybe a reset of these multiples for some of these big cap tech names near staples, consumer staple multiples, because for some reason, we've never really questioned why those names like Procter and Coke are able to kind of maintain those well above market multiples.
Okay. First of all, if you bought something like Procter & Gamble, imagine what you bought it for. Did you buy it because you expected them to somehow generate organic growth and be this new big player and take over something, or, find a bunch of new customers? I'm guessing the answer is no. I'm guessing that it's just we expected it to be a steady Eddie. It's got decent fundamentals. We keep it in the portfolio to be smooth, right? If you're buying mega cap tech names, I'm willing to bet that your expectation is that they are going to grow quite a bit more than something like a P&G or like some consumer staples. In which case, maybe you're willing to pay a little bit more for that growth opportunity. But that also tells me that the multiple that they're sitting at, and if it goes even higher, is probably fragile if that growth does not come to fruition, and or if rates stay high or go even higher, which they've been grinding higher a bit in the last couple of weeks. So I think that the multiples on big tech are probably a little bit more at risk than what you're looking at in the staples arena. However, if you just think about as a customer, right, as a consumer, which Guy mentioned is such a huge part of the economy, if we have a downturn, everything's going to go down for a little while. That's just how this works, right? That the multiples are going to come down. The expansion that we've seen in multiples probably is not durable through a big downturn, especially if earnings come down even further, which would suggest that multiples should be even lower. The last thing I want to say about multiples, and I'll have to double check the data on this, but I'll say it just kind of roughly. Because of the way the index has changed, because of how much of a weight tech is versus what it was, let's say 15 or 20 years ago, and this actually is a little bit of a positive spin if I'm able to make one, the multiple that we see today, if you would have kept the weightings, the sector weightings the same and rolled back, let's say 15 or 20 years, the multiple would have been at least 1 times higher. Vice versa, if you kept the weightings from 15 or 20 years ago consistent to today, the multiple would be about 1 time lower. So it's probably going to stay higher, even in a downturn, than what we've seen in the past, which is why I don't think that we get back down to 11 times. I think that if we do have a pullback, it's going to be something more like 15-ish, something like that, which is where we got to in October. But 18.2 is too high.
Part of the bullish thesis, by the way, that I've heard, people saying that in an environment globally that we're witnessing, people want the stability, and I'm using air quotes now because you can't see me, of the U.S. equity market, which is why they'd be willing to pay up in terms of multiple and in terms of valuation. And I can understand that to a point. And quickly, I don't drink the Coca-Cola that often. I actually drink it when I'm on an airplane. For some reason, it tastes better because they give you the entire can. By the way, that's a great line, of course, from a movie. If you recall, would you like that in the can? No, I'll take it right here for you folks again playing our home game. But I had a Coca-Cola on the way back yesterday, and I knew they were going to report today. And organic growth is code word for we're basically screwing our customers. That is what inflation is. And I think the organic growth today for Coca-Cola was about 11% off, I think, a 3% or so sales growth. So that to me is, if you want to look under the hood where inflation really is, look at some of the, again, quote unquote, organic growth numbers out of Procter & Gamble, Coca-Cola, and Pepsi. And quickly, Dan, if you want to go to your FactSet charting machines, Coca-Cola made an all-time high, I think, around this time last year, early May or so of last year, 67 and change, had a leg lower. Now here we are again around 65. I mean, for you armchair technicians out there, we might be putting in a bit of a double top here in the company that comes out, KO.
KO. It's interesting. There was an article in Bloomberg over the weekend, and it was talking about hedge funds place biggest ever short on benchmark treasuries. And so they're obviously, just some of the quotes here, they're just eyeing stickier inflation. I mean, and Peter was talking about this also in his note this morning, is that even though, we've seen a massive decline in inflation from year ago readings or from summer of 2022, it really now is going to be focused on the rate of change, right? And how much it's kind of above, what the Fed really would like it to be. And so that's going to be the reason why we're likely to see higher for longer. And that was a theme, I think, when the markets were at their lows in October, a lot of people were focused on that notion of higher for longer, which gets us to, the 10-year has come down, and we could all agree that's probably more reflective of growth. The 2-year is still, above 2%. Fed funds is about to be above 5% here. And even if the Fed says at their May 3rd meeting, they're done raising, if they were to go and say that, okay, the knee jerk might be to buy stocks. But if you were kind of going by the playbook of the pre-pandemic levels, of just kind of low rates, and the Fed's got your back, Fed put, that sort of thing. And then that was obviously confirmed during the pandemic in 2020, and then obviously throughout 2021 with quantitative easing. I mean, the thing that you might get wrong about it this time is that if the Fed were to materially lower rates from that 5% Fed funds rate, right, to somewhere where you think is going to be more constructive for equity valuations, the reasons, and Guy, you've said this again and again, the reasons why that happened are not going to be really probably that beneficial to stocks, right, in general. So again, and Alf hits this in our next part of this conversation here, is like what breaks next. And what breaks next might not be something that is culminated with just a 25% peak to trough decline in the S&P 500. Thoughts on that, Liz?
Yeah, I mean, I've said this, I feel like ad nauseum. Last year, the 25% decline that we saw was based on the belief that we would have a slowdown in growth, but there was no guarantee, and there wasn't a widely held belief that we would have a recession. Since then, I think many more people have jumped on the recession bandwagon and said, you know what, it's probably more likely than not. And even things like if you look at the near-term forward spread, which is the 3-month yield today versus the 3-month yield 18 months from now, which is the Fed's preferred measure of recession timing, it's showing more than an 80% chance of a recession in the next 12 months. So there have been more and more people that have said, you know what, it's going to be really hard to avoid one. So a 25% decline is, yes, absolutely characterized as a bear market, but it is not absolutely characterized as a recessionary bear market. A recessionary bear market is usually beyond 30%. I believe the average is actually 44%. So if we do confirm a recession, and a classic recession, not the fake one that we had in the beginning of last year, but a classic recession where cyclicals get hit, growth slows down, it resets the business cycle, inflation is taken care of, we probably do need to see a little bit further drawdown in stocks. I'm not going to call a bottom. I'm not going to say anything like we haven't seen it yet, whatever. But if you look back at history, and I know history rhymes, it doesn't repeat, that bottom usually happens after the Fed starts cutting. Right? And this time, if they start cutting, it's not going to be for the best reason. So we have to pay attention to that. The market still has one cut priced in for sure by the end of the year. I actually agree with that.
History rhymes with mystery, Dan, for you Sarah McLachlan fans out there.
Building a mystery?
Build a mystery. Yes, very well done by you. And it is a bit of a mystery to me is why people would think there's going to be magically the Fed cutting rates in the back half of this year, which, by the way, is fast approaching with an unemployment rate of about 3.5%. It just does not make a lot of sense to me. What would be the reasons to cut rates in the back half of this year, unless, to your point, Dan, something really bad happened?
Yeah, and just to kind of bookend this whole conversation, I'll just say this, is that, the Savita thing is interesting, and everybody, reserves the right to change their mind, right, and to kind of tweak their outlooks, especially when you're doing the sort of work that she's doing on a macro level with a whole host of different inputs, right? And so when we're starting to get the micro data, which is earnings right now, those are the sorts of things. The further you get throughout the year, those are the sorts of things that cause you to kind of rejigger a little bit some of your outlooks. I'll just say this though: if I'm looking at the S&P 500 chart, I'm looking at it, to Guy's point, at 4138, exactly where it was when he left a week or so. It's up about 9% from its March lows when things felt pretty bad in the midst of that kind of banking crisis. And remember, the Fed, the Treasury, the FDIC, they all took extraordinary measures, right, to kind of stopgap that little situation here. And I'll point people to the article that we just mentioned from the Wall Street Journal over the weekend. There's a lot of very prominent market thinkers quoted in there, says we're not likely done. I guess as I think about earnings season right here, a little fear in the market, a VIX around 20, an S&P that's come in 4 or 5%, a NASDAQ that's come in maybe 6 or 7% over the next few weeks. That might be the sort of thing that actually sets the stage for better entry points if you're looking to be constructive on different parts of the market. And so to me, when I look at the level of complacency we're seeing, I look at the technicals here, I look at the valuations where they are, I look at the fact that the things that were causing a lot of fear about a month or 6 weeks ago are causing no fear right now. now, I say that's not the sort of situation that I think is like, I don't want to buy that for a breakout right here, if that makes some sense to you guys. So Liz, last word here as we go into, like you called it, a very important week for the markets.
Look, the other thing, just to follow up on your statement, it doesn't have to happen in a huge fashion. There doesn't have to be like a 1 week drawdown and we just take care of it. It could be a situation where it grinds lower for a while, and that's going to feel like a really excruciatingly long time, but it doesn't have to happen in one way or another. This is, and I know we say this every week, and my analyst always makes fun of me when I say this is going to be a really interesting week. He's like, you say that every Monday. Yes, I do. But this one is a really big one. We've got a ton of economic data coming. We've got a ton of earnings coming, the beginning basically of tech earnings, so we can see if they've done enough so far. And the economic data, I don't think is going to be necessarily something that surprises us yet, because I still think a decent amount of it is going to come in pretty strong. But you've got something like durable goods coming out, which usually kind of flies under the radar. Sometimes the market reacts to it if it surprises big. Durable goods is a good indicator of how things are looking for the next month or so. So watch that number. That's something that consumers change their behavior on pretty quickly. And the other thing I would say is we could end up staying in this range until and unless we have a catalyst to do otherwise. And that catalyst could be something that sends us to the upside. But I think we're stuck here, to Guy's point earlier, the entire last week where things seemed like they didn't really change. We're stuck here because nothing has really happened yet that has sent the market or surprised the market in either direction.
Excruciatingly long, by the way, are words to describe people's conversations with me from time to time. I'm sure most people feel that way, number one. Number two, what we didn't talk about, but apparently has been transpiring, the Speaker of the House has promised to get this debt limit thing done, although I'm hard-pressed to believe that he has the votes to do such. In Congress, we will find out, but I think the market's sort of taking its cues from some of his words in terms of some of the stability. But number three, Dan, you and I have gotten to know EY from SoFi rather well over the last few years, and it's been extraordinarily rewarding, I think, for both of us. But I find her to be somebody that keeps her promises. And I know she made a promise, I believe, to one of our Twitter viewers, listeners, whatever that term would be, to address something. So perhaps EY from SoFi, we can get into these ODTE, which I believe stands for 0 days till expiry options.
Yes, I did promise somebody. I got a question on Twitter about this new index that is starting today. The CBOE released a 1-day volatility index because they were trying to find something that could track the fact that 0 days to expiration options have become such a popular thing. The regular VIX is a 30-day index, so it wasn't catching all of that activity. And as we know, the 0 days to expiration options have been quite active every single day, and it felt like the regular VIX was not catching the real volatility that was happening in the market. I don't know yet if it's going to work. I don't know what it looks like at this point, but it started, it's out there, it's live, it's down for the day so far, but we'll see how the rest of it goes and we can cover it as it comes in. But I think so far, I think it's a good thing. I think it's good to have more measures of this on a daily basis. Maybe it'll expose some stuff that's actually going on under the surface of the market.
All right. Well, thanks for that, Liz Young, EY from SoFi, for joining us on the Monday edition of On the Tape. Guy, it's great to have you back. Everyone, we appreciate you listening. We have a special drop of a OK Computer. It will also be in this feed. Check it out tomorrow. I have Gene Munster of Deepwater Asset Management. We are going to take a look at all the major tech earnings. We're going to get his rundown as a bit of a preview into that. So that will drop in the feed tomorrow morning. Stick around. Right now, Alfonso Peccatiello of the Macro Compass joins me for a very excellent conversation on his outlook for the economy, for the markets, and what he's most focused on to kind of get his read on both.